Okay, we're looking at question 2 on page 111, and it's asking us to calculate income tax for both people in 2017. And Gavin Hughes is single, and his sister is 24 years old and single as well, and she's receiving a covenant. So really it's just checking if you know how to deal with a covenant from the payer's point of view, who's Gavin Hughes, and the receiver's point of view, who's Shelly. So if you want to take a read of it there, you can pause. And we'll go down. The salary is going to be Schedule E. It's very straightforward. For Gavin, 40,100. He received commission in addition to his salary. Not all of it was paid until, so some of it was paid in 2018, but Schedule E is taxed on an earned basis, so it's whatever you earned. So likewise with a bonus, if that you include the bonus or you include commission when it was earned. So we'll tax the whole amount of 12,250 in 2017. Next is BIK and company car. And it tells us its business kilometers and the tax reference material. The more you travel for business, the less the BIK, but the default position is 30%. He's only traveled 9,200, so the percentage, the BIK, is going to be 30% of the original market value of the car. So 30% by 30,800. Which is here. So I've written here no reduction for low business kilometers. So there is a reduction as well as the reduction in percentage for high business kilometers. There's also a reduction if you're doing city travel, but you have to meet all these requirements. So in this one, I think it says in the question, he spends 50% of his time, which doesn't meet the 70%. So I've ticked the ones there. So once you have to meet all of them. So once we realize he doesn't meet this one, we can't claim it. And there he met that one. He's a full-time employee, but he didn't maintain a logbook. So he only met 2 out of the 4. He needed to have met all 4 of the conditions. If he had met them, the BIK would be 9240, and then we'd reduce that by 20% or multiply it by 80%. Again, it would go down to 7392, but it doesn't in this instance. Then we just go through the rest of it. So that's the Schedule E done. Deposit interest net of dirt. Dirt in 2017 is 39%, so we gross it up by dividing by 61%. The same with the dividends. Now it says received. It should really tell us if it's net or gross. We'll assume it's net here, and that means it's net of 20%. So an Irish company will always withhold 20% of the dividends. And that's on page 89 in the book. So it's always on the dividends actually received. You don't care what year they relate to. So whatever dividends are received in 2017, in this example, those 3, and we don't care about this one received in 18, and we don't care what year, what financial year they relate to. All we care about is when they're received. But it explains here about dividend withholding tax, and the Irish company will always withhold 20% of a dividend, and then we can claim, or the taxpayer can claim a tax credit for the 20%. And then the company themselves have to do a DWT return and pay the tax withheld to the revenue within 14 days from the end of the month in which the dividend is paid. And it tells us certain recipients are exempt, but You can read all that yourself. So in this question, we gross up the deposit interest, we gross up the dividend, the whole lot gets added up. That's his gross income, 63,439. And then that gets reduced for any allowances or charges. And in the question, it tells us he paid a covenant. And he paid it. It's important who he paid it to. So covenant, remember, is a legal payment. It has to be for greater than 6 years. So in the book on page 64, it tells us charges and income or payments made by an individual can be deducted from income tax. So they're like an allowance. They reduce your taxable income, and it depends who you pay it to. So the covenants must be for 7 years, to qualify for the tax relief. And in this instance, it's to an adult. It's to his sister Shelly, 24 years old, to an adult and permanently incapacitated. So that qualifies. Here, tax relief is available in a covenant to an adult if the covenant is in favour of permanently incapacitated. So that's it, and there's no restriction. Like in this instance, another instance to an adult is if the adult is over 65, and then the most you can deduct is 5% of the income. But that's not the case here because we have his sister who is permanently incapacitated. So he can, whatever he pays, he's allowed to deduct. If Shelly, if it was to his aunt who was 66, the most he could deduct was 5%. So 10,100. If it was to an aunt who was 70, the most that could be deducted would be his income, 63,439 multiplied by 10%. I suppose I could nearly do that. No, 5%, isn't it? Sorry. 63,439 by 0.05. So 3171 would be the deduction for the covenant. But here there's no 5% restriction, so you're allowed to take the whole covenant away. And remember, when he pays the covenant, he doesn't actually pay 10,100. He'll withhold 10%. Sorry, 20%, 2020, and he'll pay that tax over to the revenue. And how he does that is he gets a deduction for the gross covenant, but when he calculates his tax due after non-refundable tax credits, he adds tax due on the covenant. This is the tax he withheld from the payment to his sister Shelly, or his niece, whoever it was, 2020, and that gets increased his tax. So they're the two places the covenants come in. You deduct it as an allowance, and then you add the tax in after non-refundable tax credits. So then we calculate his tax. Single person, 33,000 at 20%. Dirt, the deposit interest gets taxed at 39, and then the balance is at 40. And then we give him his tax credits. He's single. He gets the payee tax credit. And he paid third level fees. So there are 3. Private health insurance, and it says tax relief given at source. So that's discussed in the book on page 63. Tax relief at source is granted on some payments where when you pay the amount, you automatically get tax relief of 20%. So it's the cost of the service reduced by the amount of tax relief available. And then what that means is, what's important for us, where tax relief is given at source, there will be no further claim for tax relief on the tax computation. So we can ignore it in the tax computation because you've already got the tax credit. So the two common ones are medical insurance. So you don't pay the full amount, you only have to pay 80%. The only complication is sometimes if an employer pays medical insurance on your behalf, you can, because you didn't claim or pay yourself and get the tax relief at source, then you can include a tax credit, and then you might have a BIK as well. So that needs to be looked at separately. An example, mortgage interest, common one. So depending on when you purchased or took out your mortgage, you may get mortgage interest relief, but it's given at source. So when the mortgage repayment is made to the bank, the amount of tax relief will be deducted, so you pay less interest. The bank gives you the relief at source, which means you do not have to do anything in your tax computation. So we can ignore the private health insurance, but in your computation you just say tax relief given at source, no further credit to be given. So there are the, I didn't write it, did I? Oh, I did. So they get added up. The third level fees is in the tax reference material. So it's a part-time course. The first 1,500 is disregarded, and then you get relief 20%. So 2,390 is part-time, minus 1,500 by 20% is the credit. And that's more or less it. Take away the refundable tax, add the tax due on covenant, and take away tax already paid. The second part of it asks us to calculate Shelly's income tax, part B. So fairly quickly I'll run through that. So covenant is taxed under case 5. So she only received 80% of that covenant, 8,080, but she gets taxed as if she received the whole amount. Her only income was this 7,100. That's Schedule E. So we add the two together. That's her taxable income. It gets taxed all at 20%. And then the credits. A single person. The payee, she gets a salary of that. She can't claim the full 1,650. The payee credit is 1,650, but you have to earn at least, divided by 20%, you have to earn at least 8,250 to get the full 1,650 credits. So she only earns how much? 7,100. So she'll only get a credit of 20% of that 1,420. And medical expenses 20%. And if you see here, get rid of this bloody thing. Her tax was 3,400. Her non-refundable tax credits were greater than that, but all they can do is reduce tax to nil. So there's no refund, even though, so she's wasted, even though if we say 3,612 minus 3,440, she gets no refund of 172. Just all that non-refundable tax credits can do is reduce the tax, this thing here, to 0. And the refundable tax credits are the any payee paid, and there was none in this question. But she's already paid, or what's his name, Gavin has already paid the tax due on the covenant on her behalf, so she gets that as a refund. And that's the end of that question. So thanks for watching, and I hope that was useful.